My agenda today, I'm gonna, I always start with the confessions. What did I think was going to happen last year? What actually happened? What did I get wrong? I got a lot wrong. Performance recap in the economy, and then my 2020 forecast, and then I'll tell you a few things that keep me up at night, and then I'll close on some good news. I don't have a Wisconsin forecast this year because we're saving time for the panel, but I'd be happy to take questions about that. So last year's outlook, now, I thought the S&P would be flat. So at least I didn't tell you to sell, okay? I didn't tell you to sell. But keep in mind, we had just been through the fourth quarter of 2018, and I think at the end of last year, there was a lot of concern, will the sell-off continue? I didn't really think it would. The economy seemed too strong at that point, and I was pretty convinced that the president would be motivated by the election around the corner, and we would do everything possible to kind of keep this recovery moving along. I thought GDP would grow not quite as robustly as it has, partly because the sell-off was so severe in the fourth quarter. And then I thought unemployment might be creeping up by year end. At this point, it actually has continued to fall all the way down to 3.5%. I thought it would be creeping back up above 4, which is still quite low. I didn't think we had much more juice left in labor force participation, which is part of the reason my GDP growth forecast wasn't as aggressive. But it turns out labor force participation has continued to tick up in all age groups. I thought we would see a little bit more wage growth in this recovery by now, partly because of the low unemployment rates and tight labor market. We really haven't quite seen that, so wage growth still hovers around 3%. And with productivity growth being what it is, that means inflation is still just barely above 2% year on year, both core inflation and all items. So really, in a nutshell, what did I miss last year? I overstated the extent to which inflationary pressure might be building in what looks like an economy at capacity, and as a result, underestimated the Fed's latitude to cut rates. So easy money was certainly a big part of the story of this recovery. And because of those rate cuts, that spurred a little bit more real growth, employment, and also certainly was favorable for equity valuations. So that's what I got wrong. I probably would have to give myself a C- or a C on that forecast. I certainly wasn't on the recession bandwagon, as some people were with the decline in equities at year end, but I could have done a better job. So what do we have to look forward to in the year ahead? Well, we just signed the trade deal with China. That's something noteworthy, of course. The stock market is roaring. I mean, we're basically at all-time highs, give or take a couple percentage points on any given day. We've seen some aggressive geopolitical actions in the Middle East that so far don't seem to have caused major disruption. And then in Washington today, we have impeachment hearings continuing on, and then we have an election coming up at year end. So these are all things that, for me, will kind of factor into what the overall forecast is and backdrop. This is the longest expansion on record. I capitalized all caps best. Maybe you guys can figure out why. It is the best expansion. It really is. And, it's worth taking stock of that. I mean, one reason for it is easy money is back, not just in the United States, but worldwide. Central banks have really kind of flooded markets with liquidity. I'll come back to that at the end of my talk. It's something that, frankly, concerns me a little bit. I don't know how the movie ends on quantitative easing, and we might be calling that something else someday. The other thing that's keeping this expansion going, to be honest, is a business-oriented president with a laser focus on the economy and markets. I think it's noteworthy that we've probably, I don't recall a president who's up until taking office was really just being involved in business. Most presidents have more of a legal background. This president, that's what his life had been, and he is very focused on economic performance and the state of the stock market and exerts a lot of leverage, more leverage than I've seen any president exert in making sure that the economy keeps growing to the best of his ability, including, doing things that Some people think presidents shouldn't do. We shouldn't try to pressure the Fed to cut rates. They're independent. This president doesn't really worry about things like that. And, it has shown up in a record-breaking expansion. When the 2016 election happened, I frankly thought it wouldn't be a bad idea for whoever won to consult with the Fed and say, hey, let's get interest rates back up where they belong in this world and maybe put the economy through a recession, and that way we'll be growing by the time 2020 comes and I can win re-election. That's kind of what happened with Ronald Reagan and Paul Volcker at the Fed. And it seemed like it might be a good time to do that if you were interested in re-election. This president has powered this economy, and it will cross the finish line at the end of this year, I predict. Still growing, maybe slowing down, but that is noteworthy. And so I think presidents with a legal background, they think about laws. What laws does the country need? What can we do to make things better? And this president thinks about getting laws out of the way because he trusts business to do things right. In a nutshell, I think that's just his gut. So certainly deserves some credit, and that's why I think we have lighter touch regulation, which is favorable for business. The impact of the corporate tax cuts continues to ripple through and have positive effects on the economy. Of course, we have very low unemployment, so people are working, they're getting paid. That helps everybody. And then we have record-setting household net worth and buoyant consumer confidence, and really no sign of overheating other than the weather outside here and the rain that we have today. So that's, this is a record-setting expansion, and certainly that's something to be proud of. And as I take stock of all the indicators today, you'll see there is no indicator that isn't in great shape really at the moment. So real GDP growth in this expansion, as you can see, this is GDP growth back to 1960. What's amazing about this is the GDP growth rates really haven't budged off of 2 to 2.5%, more or less, through this entire expansion. So it hasn't been choppy. It's been very steady, not really high. We haven't seen the 3 to 4% growth rates that you occasionally had in the past, but very steady. Unemployment continues to drive lower. As I said, labor force participation trending up, both in prime working age individuals on the top panel in blue, but also in seniors. And that may or may not be a good thing. When the labor force participation rate of people over 65 is going up, I think some of that is probably driven by people feeling like they have to work. That could be a consequence of greater longevity, could be a consequence that maybe wages haven't grown enough and people don't feel confident about their retirement. So that could be a mixed message, but certainly the prime age participation rising seems like a good thing. Household net worth is at an all-time high. The S&P index has outperformed the global index by a wide margin in this expansion. You can see here from 1970 to the present, there really was kind of no advantage to being invested in the U.S. or rest of world through most of this period. But over this recovery from the Great Recession, the U.S. market has really dominated, which could mean it isn't a bad time to rebalance. I don't think you could see this degree of outperformance in the next decade by the U.S. relative to the rest of the world. Whether the rest of the world catches up or not, unclear. Consumer confidence, what isn't there to be happy about with all the great news that we have about the economy? And then the CPI, for me, that's really the dog that hasn't barked, so to speak, in this expansion. Usually when you get an economy this hot, you would start to see signs of price pressure, and I'll talk a little bit about that in a minute, because that to me is one of the great mysteries of this expansion. You'll recall last year we talked a bit about that flattening yield curve, and in fact, even kind of an inverted yield curve at some horizons. So if you looked at certain interest rate spreads, you did have yield curve inversion for moments between the 2-year and the 10-year interest rates last year around this time. And that is often thought to be a harbinger of recession. Of course, what's unusual today is the interest rates are so low across the yield curve, they're bound to be close to inverting, and we've seen now kind of a steady margin of about 25 to 30 basis points between the 2-year and the 10-year, and we have an upward sloping yield curve, but very modestly upward sloping. So that doesn't seem to be flashing any signs of recession either. So my 2020 forecast, I'm basically almost going to try it again. I'm going to try it again. Maybe this year it'll be right. But at this point, it's hard for me to see over the course of the whole year that we'll finish with an S&P much higher than we started the year. That's not terrible. I mean, this has been a great bull market in the U.S. What I do think is we might have a little momentum yet in the S&P for a while, but I expect over the course of this year, as we get toward the election, things may start slowing down, and when they do, equities usually lead the way. So I wouldn't be surprised if we're up at the midpoint of this year and then down a little bit. Kind of the opposite of last year. I thought we might be down a little bit more going into the year, coming off last December, and then recover. GDP growth, I'm going to stick with what I thought last year. And why do I say that? Well, I don't see labor force growing enough and productivity growing enough to get us much beyond 1.7%. You basically need more hours worked or higher productivity per hour worked to get to your GDP growth number. And I don't really see the growth in the labor force like we've had this past year. I don't see unemployment rates going down another 3 or 4/10 of a percentage point as they did this past year. And I don't see labor force participation rates going up quite as much as they did. So we'll see how that comes out. I do think because the economy may be slowing at year end, we might actually see unemployment rates tick up from 3.5%. 3.8% though is still low, so still a very strong economy. Stable labor force growth, and I'm going to say wages and inflation actually perk up a little bit, not dramatically, and I think that may constrain the Fed's ability to be more lax. So basically my forecast would be we are very near capacity. I think we will finally start to see some price pressure. I think growth will slow during the course of the year because we don't have enough new workers coming online, and that the equity market will cool as a result of all that. But nothing dramatic. I also think the urgency to push the economy hard that we've seen from the president may wane a bit because as we come into the home stretch of the election, the economy's growing. In a sense, we achieved what we needed to achieve from that perspective. And so I don't know that we'll see quite the same urgency. Although the president does like to win, so we should revisit that next year. So what are the forecast risks? My baseline forecast certainly assumes a business-friendly election outcome. That would be the re-election of President Trump, Mike Bloomberg, maybe Joe Biden. I could see the business community feeling like we can work with Joe Biden. I think if Sanders or Warren were to get incredible traction and people started to think that was a possibility, that could change people's outlook about the economy quite dramatically, and certainly at least markets would get choppy in the short term. I don't know that it would be bad for the real economy because we might see a lot more government spending and people's college debt being wiped out, et cetera, if you thought that was possible. So people might keep spending, but I don't think it'd be great for the stock market. The tight labor market and tariffs, I think, will create some price pressure, and that may inhibit the Fed from being quite as expansionary as they have been. The usual geopolitical wildcards always exist. So far, the strike at the Iranian Revolutionary Guard leader hasn't led to any bad consequences for the rest of the world, but I don't think that tale has been told yet, and we'll see what happens in the Middle East. But certainly if the oil market were disrupted, that could change things. And then finally, I guess the thing I always worry about, the economy it really benefits from everyone having a positive outlook. If we all think positively about the future, we're confident in our spending, businesses are confident in their investing, and that's what keeps the machine turning, right? When people get pessimistic about the future, that all goes in the other direction. And so you always have to ask, are there things that we could be pessimistic about? And I'll tell you what I think the ingredients might be a little bit at the end of my talk. One of the things that we see today is, these populist movements or nationalist movements around the world, but really, I'd say there's a strain of populism out there that is really starting to question capitalism more than we've seen, in recent years. And I think that results from the intense competitive pressure that everyone in the business environment feels today. Even though it's a great economy, make no mistake, there's a lot of disruption going on out there, and I know Jack will say a few things about that in the insurance business. It's led to, massive changes in how American family looks at the world. And just the sheer uncertainty of capitalism that comes with, global trade disrupting certain industries, or the digitization of the economy disrupting different industries. You see it in retail. Taxi cab business is a different ballgame today. And so you see that kind of disruption, and that makes people uneasy. And I think a lot of people, kind of want to get off that merry-go-round. If you're not one of the winners, if you're not driving that change and it's being foisted upon you, it doesn't feel the same. So I think, those forces of trade and digital disruption have created some challenge for capitalism. They disrupt industries, they disrupt regions. The Wisconsin economy on balance probably hasn't been one of the, more fortunate economies in the United States. The Great Lakes generally, which was heavy in manufacturing and agriculture, hasn't really kept up with the coasts where most of the technology businesses have developed. Some of the solutions to that, that we could make within our capitalist system, I think are, bigger and better public infrastructure projects that probably spread employment around a little bit more, improving the education and skills of more people. So, takes pressure off of the less skilled segment of the labor market by moving more of them into higher skilled areas. That'll lift up wages at the bottom and create a little more competition at the top, even things out a little bit. And then redistributive taxes are another thing that people will certainly be talking about. But, that's one thing in the background that I think needs to be addressed through public policy. Where is the wage and price inflation? That's, as I said, probably the biggest thing I missed in my forecast. Well, wages, maybe there's not as much wage pressure in a tight economy because today, certainly union power is greatly diminished relative to where it was the last time we had unemployment rates down in the threes, which was like the late 60s. There was a lot more union bargaining power then. I think there's a lot of fear of technological displacement in many jobs, even in industries that are doing well. Even an industry that's doing well, there's innovation going on and it changes the nature of work, and I don't think workers feel as bold about pushing hard for wage increases in that kind of environment. And then I'd say the third factor is really that benefits have been rising as a share of compensation. So even if wages are only growing at 3%, it may be that total comp is growing closer to 4% in some years, depending on the cost of those benefits and the employer provision of them. So one reason we don't have price pressure is the lack of wage pressure, but there might be other reasons why we wouldn't have price pressure. Things could be happening with margins, and indeed, you see really fierce competition in many parts of the economy because of these disruptive business models. The specter of Amazon makes everyone think differently in almost every industry. It almost seems like there's no place that they couldn't go. The global coordination of monetary easing is another reason that we don't see inflation in the U.S. If we had an economy this tight with low unemployment rates and a 5%, approaching 5% federal deficit relative to GDP, and the kind of monetary expansion that we've seen, if other countries weren't behaving as aggressively with their monetary policy, we would be in a rapid currency depreciation situation, and that would bring a lot of inflation to the U.S. Price of imports would go way up, and that gives domestic producers cover to raise their prices. So that's what would normally happen in an economy like this if it weren't that the rest of the world is kind of in almost worse shape than we are, okay? So that has given us a little bit of latitude. And finally, I think, the monetary transmission mechanism today may operate more through asset prices than goods prices. When I got my Ph.D. in economics, we only thought about money being transmitted to prices in goods and services, but I think today it may be that at the margin, more of what the Fed is doing is creating wealth for people who are investing rather than buying goods and services. So that might be a change to how we used to think about things. What keeps me up at night? I'll go quickly through this, and you can ask questions about it in the panel if you want. I've said for a long time, the global environment keeps me up at night. We haven't taken great care of air and water historically. The United States has gotten a lot better about that. Other countries are kind of doing what we did 50 years ago. It puts a lot of stress on the planet, and we should all be concerned about what kind of planet we're leaving our kids. Globally coordinated quantitative easing is a new thing. We've been doing it for 10 years. It's a good thing everybody's doing it, like I said. It seems like a bit of a way to kick the can down the road and run these big federal budget deficits and not really see many consequences of that. So someday we may look back on that as an intergenerational Ponzi scheme. We'll see. Large deficit and debt to GDP ratios with so many unmet public infrastructure needs. We've done all this spending. What did we really get for it? Not a lot in terms of public infrastructure, I would argue. If anything, the state of that seems to be in a bit of decline. And then, we've had a disruption of what I would call the traditional post-World War II international order. And if those alliances dissolve, that's going to create a lot of uncertainty. Remains to be seen if that will happen, but we're certainly in a different place. And then I'd say there's kind of an erosion of trust in institutions and leaders and the incentives to lead public institutions. So this was a survey that the agency Edelman and Associates did, asking people, will they think they'll be better off in 5 years? And in the US, most people don't think they'll be better off, which is pretty surprising. It's even worse in Germany and Japan. And then the percentage of those surveyed who agree that capitalism is working for them is less than 20%, and nearly 50% of people think it's failing them. So, that's probably something we should all be concerned about. The good news that I have for most people as I look out at this audience, there was an economic study that found that the worst time of your life is when you're 47.2 years old. I'll be 60 in April. I am on the really steep climb of happiness now. And the great news for Wisconsin is our life expectancy is higher than most of the rest of the country. So we got a lot of great times to look forward to. It's always a pleasure to be here with you. Thank you for listening, and enjoy the rest of our program.